Ever wondered how Warren Buffett became one of the richest men in the world through investing? It wasn't through a quick windfall, but rather through the slow and steady strategy of long-term investing. This approach, my friends, is like a marathon, not a sprint. It's about buying and holding assets over extended periods, often years or even decades. Throughout this video, we'll uncover the intriguing world of long-term investing. We'll explore how to hunt for profitable companies and the art of value investing. We'll delve into the power of dividend reinvestment and the benefits of exchange-traded funds and mutual funds. We'll also discuss the strategy of asset allocation and long-term cost averaging. Remember, investing is not about getting rich quick. It's a journey, a process of building wealth over time. Like a bucket filling drop by drop, your investments can grow and compound over the years. Investing might seem complex, but once you grasp a few key concepts, it can become your path to financial freedom. Picture yourself as a hunter, but instead of hunting game, you're hunting profitable companies. You're in a vast financial wilderness, equipped with nothing but your wit and a keen sense of observation. The game? Profitable companies. The reward? A healthy, robust portfolio that grows over time. How do you spot these elusive creatures? It's all about examining their tracks, their signs. In this context, that means delving into their financials and business model. The financials are like the footprints of a company, telling you where it's been and hinting at where it's going. Look for companies with strong balance sheets. These are companies that have more assets than liabilities, indicating financial health and stability. Next, consider the company's income statement. Is it consistently making a profit? A company that is regularly profitable is like a well-fed, strong animal, more likely to survive the harsh winters of economic downturns. Now let's not forget the cash flow statement. This reveals how well a company manages its cash, akin to how well an animal manages its resources. Companies that generate positive cash flow are more capable of investing back into their business, paying off debt, and returning money to shareholders. Beyond the financials, you also need to understand the company's business model. Is it sustainable? Does it have a competitive edge? The business model is the habitat in which the company thrives. A company operating in a growing market with a unique product or service is like a creature well adapted to its environment, more likely to thrive and less likely to fall prey to competitors. Buying stocks in these companies is not a short-term play. It's a long-term investment. Consider it as making a home in this financial wilderness. You're not just passing through. You're settling down, building a future. This is how wealth is created, not by chasing after quick profits, but by patiently hunting and gathering profitable companies. Remember, hunting for profitable companies is like finding treasure. The more you find, the wealthier you become. Value investing is like finding a diamond in the rough. Imagine walking through a marketplace, bustling with vendors hawking their wares. Amid the noise and clutter, you spot a seemingly unremarkable stone, overlooked by many, but you, with your keen eyesight, recognize it as a diamond in its raw form, yet to reveal its true worth. This, my friends, is the essence of value investing. Value investing is a strategy that involves hunting for stocks that appear to be undervalued by the market. These are shares of companies that, for one reason or another, are trading for less than their intrinsic or true value. Just like our diamond in the rough, these stocks are often overlooked, ignored, or simply misunderstood. But how do you determine a stock's true value? Well, this requires a careful analysis of a company's fundamentals, including its earnings, dividends, assets, and growth potential, among other factors. It's not about following the latest stock market trends or jumping on the hottest new IPO. Instead, it's about digging deep, doing your homework, and making informed decisions based on your own assessment of a company's worth. But why is value investing a great strategy for long-term investing? Well, the answer lies in the nature of the stock market itself. The market is often swayed by short-term trends and sentiments, causing stock prices to fluctuate. But over the long term, the market has a way of correcting itself, and undervalued stocks often rise to reflect their true value. This is where patient investors can reap significant rewards. Value investing also provides a margin of safety. By buying stocks below their intrinsic value, investors limit their downside risk. If the market doesn't recognize the stock's true value immediately, they have a cushion against potential losses. And if the market does eventually catch up, they stand to make a healthy profit. Value investing is not for those seeking quick returns. It's a strategy for the patient, the diligent, and the insightful. It's about seeing the potential where others don't and having the conviction to stick with your choices, even when the market seems to disagree. Value investing is all about patience and keen eyesight, waiting for the diamond to reveal its true worth. Scene script. Imagine a snowball rolling down a hill, growing bigger and bigger. That's the power of dividend reinvestment and ETFs. Let's break this down. When you invest in a company that pays dividends, you're essentially receiving a portion of the company's profits. Now, you can take that dividend payout and spend it, or you can reinvest it back into the company. This is what we call dividend reinvestment. It's like buying additional shares of the company without actually spending more money. This means you're increasing your ownership in the company and subsequently your potential profits. But how does it work? Well, the dividends you receive are used to buy more shares of the company, and these new shares also start earning dividends. It's like a snowball effect. The more shares you have, the more dividends you receive, which can then be used to buy even more shares. This cycle continues, and over time, your small initial investment can grow significantly. Now let's talk about exchange-traded funds, or ETFs. These are investment funds traded on stock exchanges, much like individual stocks. They can track an index, a commodity, bonds, or a basket of assets. The beauty of ETFs is that they offer diversification. Instead of putting all your eggs in one basket, you're spreading your investment across a variety of companies or assets. This can help to mitigate risks. So, how do ETFs and dividend reinvestment come together? Well, many ETFs pay dividends too. And just like with individual stocks, you can choose to reinvest these dividends. This way, you're taking advantage of both the diversification that ETFs offer and the compounding effect of dividend reinvestment. In essence, dividend reinvestment and ETFs are tools that can help you build your investment portfolio over time. They allow you to take advantage of the compounding effect and diversification, respectively, both of which are key to long-term investment growth. With dividend reinvestment and ETFs, your investment snowball can grow into a towering snowman over time. Think of your investment portfolio as a pie. How you slice it can make a big difference. Imagine your portfolio as a delicious pie, with each slice representing a different type of asset. Stocks, bonds, real estate, you name it. The size of each slice, or in financial jargon, your asset allocation, is key in determining the overall risk and return of your portfolio. Why is that? Well, different asset types perform differently under various market conditions. Some may soar when others falter. By having a well-diversified portfolio, you spread the risk across different asset types, reducing the potential for significant losses if one asset type underperforms. But how do you decide how big each slice should be? That's where your personal investment goals, risk tolerance, and time horizon come into play. If you're young and have a high risk tolerance, you might opt for a larger slice of stocks for higher potential returns. On the other hand, if you're nearing retirement, a larger slice of bonds might be more appropriate for their stability and regular income. Let's move to the next tool in our investment toolkit: long-term cost averaging. If you've ever been on a roller coaster, you know that markets can be just as thrilling and just as scary. Prices rise and fall, often unpredictably. That's where long-term cost averaging comes into play. Imagine buying a fixed dollar amount of a certain asset regularly, say every month, regardless of its price. When prices are high, you buy less, and when they're low, you buy more. Over time, this strategy can result in a lower average cost per share, helping you manage market volatility and potentially enhancing your returns. Like a master chef, you need to know when to add a pinch of this or a dash of that to your investment pie. Understanding the principles of asset allocation and long-term cost averaging can help you do just that. Asset allocation and long-term cost averaging are your tools to slice the investment pie to your advantage. So, how can you fill your investment bucket drop by drop? Let's recap on the key concepts we've navigated through. First, we examined the allure of buying profitable companies, acknowledging that value lies not just in the present earnings, but in the potential for future growth. Next, we dove into the art of value investing, painting a picture of how to spot undervalued stocks and the rewards that come with patience. The power of dividend reinvestment and the benefits of ETFs or mutual funds was our next stop. We learned how these strategies can boost your earnings over time, compounding the value of your investments. Finally, we discussed the strategy of asset allocation and long-term cost averaging, emphasizing how they can mitigate risk and smooth out the bumps in the investment journey. Remember, investing is a marathon, not a sprint. With patience, strategy, and these key concepts in mind, you can fill your investment bucket to the brim and achieve financial freedom.